This is TreppWire Week in Review for week ending November 26th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, President Biden nominated Fed Chair Jerome Powell to a second term and Lael Brainerd for the number 2 spot. And the holiday season starts with an estimated 53 million travelers expected this week. And with a shortened work week for many, a lot of economic data is released early. Durable goods orders were down 0.5%, and initial jobless claims dropped to under 200,000, the lowest since 1969. And a lot of focus has been on digesting the earnings of some retailers and what the forecast is for holiday spending. Manus, with a mix of data released today, what is weighing the markets down right now?
Well, before we get into that, I should kind of set the tone a little bit. We're recording early this week because of Thanksgiving, so there will be more economic news coming out after this. So we got whatever we could as of Wednesday morning. It's a funny week, I would say, because there was some doubt over whether Powell would get the renomination. There was thought that President Biden would go with the more progressive pick. And had he gone with the more progressive pick, you would think even more dovishness for the most part, with the exception of perhaps more regulation on banks. So you would think that with Powell, the market's got what they want, which is a known quantity. And instead of a relief rally, what we really got was a spike in interest rates. We're now near a 1-month high with a 10-year at 1.68%. That's always going to weigh on tech stocks more than anything else. And what we saw this week was a little bit of a tale of two markets. The Dow and the S&P either rising or at least treading water in the case of the S&P, but the NASDAQ really selling off. And I think it's now down close to 5% over the last 3 sessions, which I would chalk up really to the spike in interest rates that we've seen. So it's a little bit of a head scratcher, you know, why the markets didn't take the Powell renomination a little bit better.
Part of it too is it's kind of the buy the rumor, sell the news type thing, I think. And I think that there may have been an idea that had Powell been replaced by a more progressive Fed chair, that might have been a sign of pumping more and more money into the economy for a longer time. And I think maybe confirming the Powell pick also confirms the taper and the interest rate rise plan after the taper. And I do think that going from 135 or 140 to 165, it's actually might even be higher now, 170 on the 10-year treasury, you know, at interest rates this low, that's a large increase. And any of these tech stocks sell off on that. I also think that, you know, interest rates, long-term interest rates should be rising because growth in the economy is supposed to be strong. It has been strong the last several quarters, and it's supposed to continue to be strong as the reopening, you know, continues to gain momentum. So it's like a good kind of stock market down week for me, although we did have some negatives on the retail earnings front after a bonanza last week. So
yeah, we're going to talk about that a little bit more in great detail, but, you know, I don't usually play the cynic. That's usually your role, Joe, but, you know, the cynic in me says, you know,
where do you think I learned how to become a cynic?
You know, the Powell thing, the renomination, you know, part of that, if you're cynical, is in a way for the last 6 months, he was campaigning for a renomination, which meant really trying to toe the line of what the administration wanted, right? Which was dovishness, get the economy going, don't tighten, keep interest rates low, keep buying bonds. And now that he's back, right, you have him a little bit untethered. He can reestablish his independence, and maybe this trying to fight off inflation becomes a little bit more aggressive, right? That you have rate hikes sooner and the tapering back of bond purchases happens faster. So that's part of, you know, the calculus as well. So, but I think there's a lot going on here, and I think different investors think differently. I think you brought up a very good point, talking about how maybe there was, you know, a 1/3 possibility that they go with a more progressive choice, whose name I won't even try to pronounce because you know how I butcher names. But, and maybe you're right. Maybe that they were hoping for a more progressive type, and just the spigots don't get closed, they get even more opened going forward. So, you can't really measure this stuff. It's a lot of sentiment going out there. But what we do know is that the reaction was the 10-year is higher and tech stocks are lower.
Turning to retail last week, we were upbeat with earnings and earnings news. This week, it seems like it's a different story, with a lot of retailers accounting for high costs and supply chain snags that are weighing them down.
So we're going to talk primarily about retail today. It will be a shorter episode than usual because I know Martha needs to get to her chateau and Joe has to ride off to his manor. Haley, I guess she's got her own estate as well. So, everybody wants to do their pilgrimage to their Thanksgiving locale. So
yeah, it's a pilgrimage. It's 14 stairs from here down to the first floor.
So we'll go on to earnings, and then we'll talk about a couple of other things that are of concern. Last week, we were talking about a retail renaissance. We wondered if it was real or a false start. It seemed like, as of our podcast last week, the narrative that it was real had a lot of conviction. Macy's and Dillard's had blown away earnings expectations. Macy's was up 20%, their stock price in one day. Kohl's had outperformed. A wide swath of retailers from Walmart, Target, Victoria's Secret, Bath and Body Works all saw really strong numbers. Bad news was hard to find. People weren't really talking about inventory problems, inflation, supply chain issues. Target and Walmart had gotten ahead of the issues and had built up inventory. Many of those firms raised guidance. So it was really quite the glass almost completely full last week. And so it was hard to fight that narrative. We had mentioned last week that Barron's had a glowing front page article that touted the retail comeback. The title was "Mall Stocks Are Back in Fashion, What's Behind the Revival?" Interestingly, it started with a glowing review of Abercrombie and Fitch. And, it was all part of that really strong week for retail. You move ahead a week, and this was a really jarring week for the most part. To be sure, there were some positive numbers. Dick's and Burlington both beat expectations. They were up by about 5% and 8% respectively, their stock prices. They've been winners all along. They've been really strong performers throughout the pandemic. But on the negative side, we really started to see signs that maybe the narrative is not going to be as rosy as people were thinking last week. Terrible earnings from Nordstrom. Its stock this morning down 25%. It released earnings after the bell on Tuesday night. Absolutely crushed, hammered by higher wage costs and weak sales, particularly weak sales at Nordstrom Rack. The Gap was down 20%. It lowered guidance, missed on profits. It mentioned hundreds of millions of dollars in lost opportunity because of supply chain issues, and hundreds of millions of dollars in higher freight costs. And by the way, I should give a shout out to Lauren Thomas of CNBC, does a nice job covering all this, and some of this comes from her reporting.
Madness, I saw the Gap CEO. See, being home and not in the office today allowed me to watch CNBC this morning. I saw the Gap CEO interviewed, and I think the numbers she mentioned were $500 million on top line they missed out on because they couldn't get the supply where it needed to be, and $500 million on bottom line in additional air freight and other freight costs. Right, so that's $1 billion right there missed out on just because of supply chain issues.
Exactly. I mean, it got crushed today. I think I mentioned it's down 20%. Its stock was on Wednesday morning. Abercrombie and Fitch, which was the darling of that Barron's article, down 12% yesterday after it said its profit margin had contracted by 30 basis points due to higher costs. So just like last week, we said the wave of positive news touched everybody, right? From department stores to, the mass retailers of Walmart, Target, to the inline stores, Bath and Body Works. This week, the opposite is true. What we're seeing is a wide swath of disappointments across department stores, in the case of Nordstrom's, inline guys, Abercrombie and Fitch, and the Gap, and other people in between. So, the narrative has definitely changed this week. And, I think we're back to, is this a false start, or is this a retail renaissance? I think the jury is still out on this. And I think that the supply chain issues are not going away.
So I think we saw a couple quarters of retailers, I would say, benefiting in a weird way from supply chain issues, right? And maybe, I don't know if I can explain this well, but their inventory numbers were lower than historical numbers, right? And also they were able to either raise prices or just discount less. So you had those two virtuous things happening, right? You could charge more for your stuff and your cost of goods sold was lower, or you just weren't holding as, you had more cash to put to work versus having it stuck in inventory. And I think that's what you saw margins really expand for a lot of the retailers over the last couple quarters. And I think you got to the point in this most recent quarter, at least for some of the negative ones that you mentioned, Manus, where it started to come back to bite you, right? It's like this, it's great when you can do just in time until it's not in time anymore. And then you have to, you're missing out on potential sales, and or you have to pay a lot more to get your stuff on the shelves in time. So I think it's just a classic inventory buildup, drawdown, build up, drawdown cycle that usually happens like in a business cycle. Generally, it just happened like everything else really, really fast with all the supply chain stuff. So it'd be interesting to see how long it takes to normalize back to whatever you would call like equilibrium brick and mortar retail margins. And there were some stories out there, which in some of the earnings calls, which was that online retail sales growth was slowing, but in-store was doing really well, right? I think Dick's was an example of that. So, there's so many variables in these equations, but I do think that there are more people in person buying stuff. And there's, we say it every week, there is so much cash in everybody's pocket right now that it bodes well for retail, in the near term, as long as they can get stuff on the shelves.
Yeah, whether it's luck or great management and great buyers, great seers of how the market is going, these 6 months will really separate various retailers. Those that either have great foresight or great processes or great luck will outperform, because they may have gotten ahead of the inventory issue. They may have gotten ahead of the supply chain issue. They may have greater perfection in how they're managing inventory. And others will get slammed. And perhaps that will be bad luck, or perhaps it will be just, they don't have the foresight, or they don't have the systems in place to source things as flexibly as others. But, unlike other times where things kind of go up and down in parallel, because everybody could source things at the same cost, and there aren't supply chain issues and other, matters that you don't see coming, now I think you could really separate good management from bad management over time, as you see how people handle these particular matters, but time will tell.
So last week when we were recording and talking about how amazing all these retail earnings look, I was ready for our podcast this week to be, Black Friday, TreppWire, retail Bonanza special, right? We're blowing up the floats and we're going to the mall and we're spending lots of money. And now, as usual, we've been beaten back into a state of reasonableness on this podcast. So while the title of the podcast might still be Retail Bonanza Black Friday Special, I think we're a little bit more measured right now.
Yeah, the air is coming out of your float, Joe, a little bit, it sounds like.
So I was in Grand Central yesterday and I saw this big sign and it said, "The Great Inflation." And I was like,
Oh,
is this some sort of like sarcastic, guerrilla marketing campaign or something? And I was like, oh no, it's actually just an ad for going to watch
balloons.
them blow up the floats.
And it's back. You can watch them again this year. The spectators are back.
I went
Wow.
once, and
I want the NFT. Yeah, I once went to the parade at a friend's apartment right on the route, but I was carrying a trophy and I got knocked into it and it fell out the window and it popped one of the balloons.
Wow,
That's-
you ruined the parade?
That seems like, how did they not make a Seinfeld episode out of that?
Really?
Right?
Wow.
Jerry drops or George drops the trophy. or
Maybe Kramer did.
Wow.
Moving on.
Moving
we're
on.
going to stay on retail on something else that we're going to talk about. One last earnings number, which really kind of came out of the blue and is of a piece. I hate to say a sad piece right now for the retail segment. Best Buy was off 17% at one point on Tuesday after their CEO said the firm was seeing increased, and this is in quotes, organized retail crime, unquote, that goes along with inventory loss in recent months, all of which was weighing on profit margins. So even though the firm beat on the top line, beat on the bottom line, and raised guidance, its CEO said, they're starting to see a problem with organized crime. And what that means, I'm not really sure, right?
I'll
Organized
tell
crime.
you, people show up with a crowbar to.
Well, there's organized crime where you're taking things out of warehouses and stuff like that. And there's, other types of,
It's like flash mob type.
Right. So it's hard to know what exactly he's talking about. But I'll pivot from that Best Buy story to, in California and in Chicago, we're really seeing an epidemic of crime. So, in California, this is all covered by CNBC Bay Area News, the Louis Vuitton in Union Square, Nordstrom stores in Walnut Creek and Los Angeles, other attacks in Stone Ridge Mall in Pleasanton, Hayward Southland Mall, Fairfields, Solano Town Center Mall, the Sun Valley Mall in Concord, all were hit over the last 2 weeks. And these are not happening in the middle of the night where they sneak in and they take everything. This is happening during store hours. In Chicago, there's been 5 or 6 similar types of events on the Mag Mile. That includes Neiman Marcus and, again, Louis Vuitton. That's covered by Fox 32 in Chicago. You can look it up on the internet. And when I look at a story like this, I'm not looking at the inventory loss and the cleanup that impacts a jeweler or a handbag store, something like that. That's meaningful and that's inventory loss and that's painful. What I'm more concerned about when I see these stories is the ecosystem loss, that people say, why go to the mall? Why not just do it online, right? So we've talked about the headwinds for years about retailers, right? Exposure to e-commerce, moving on to supply chain issues, inflation, higher wage costs, and so forth. And this is now, in certain markets, another severe headwind, right? That the ecosystem is such that it's not the jeweler who has to worry about cleaning up his store and replacing his inventory and filing insurance claims and so forth. It's the mall owner, it's the restaurant owner, it's the Chili's that's near the mall. It's that whole ecosystem where people have to be concerned. I'll get into this a little bit more in a second with a very specific indication, but mall owners don't need this. And it's part of another piece of friction that is just coming at a time where they're just starting to see less friction.
So you cover the ecosystem and the inventory stuff, and even another line from the Best Buy CEO was talking about how it's making it even harder to hire people, right? I mean, think about it. It's already hard to get people to come and work in a store for $12 an hour or 15, whatever it is, right? And now you're asking them to come into the store, and there is a decent possibility that 55 people are going to show up and smash the window and run around and take everything. It's like, you know what? I'm good. I'm going to go I'm going to go make some arts and crafts on Etsy and stay home, right? Like there's several, it's bad from all angles, right? And I don't know how we got here, but it just goes to show you why people are leaving these places, right? In droves.
Yeah, I'm going to turn this now to a very specific story that we can focus on. The Westfield San Francisco Center. It does touch CMBS. It backs $560 million in CMBS debt, mixed use collateral, about 250,000 square feet of office, lots of retail. In the last couple of weeks, Bloomingdale's, Burberry, and Walgreens in that mall were all targeted. Okay. What we've seen in this mall, even before this, is occupancy has gone from 92% to 76%. And this is, a nice area of San Francisco, right? This is not a suburban mall. This is, inner city mall. DSCR going from 2.23x in 2019 to 1.28x in H1 2021. In addition to, the 3 targeted retail stores, they've lost 2 big office tenants, which represented 40% of the office space, right? So this was a loan, 45 LTV, 2.5x DSCR. On the retail side, $800 per square foot. You think when it comes to fortress lending, right, that this thing is as close to a fortress for retail as you're going to get, right? You're going to lock in your return for 10 years and you're good. And now you're seeing the DSCR has been cut in half, occupancy down 16 points. And you're starting to think, am I looking at a problem here? And maybe you are. And that's how, when you talk about this ecosystem, it all comes back to eventually that one break-in at a jewelry store reverberates to lower occupancy, lower DSCR, and eventually potentially a troubled CMBS loan.
The funny thing is that when you see these videos online, everybody runs in and then they run out and get in cars and drive away. Like, it can't be that hard to find who's doing this, right? Like we have red light cameras and we have license plates. I mean, I think it's going to be a question of how willing are, the politicians in these areas, how willing are they to enforce the law, and it's a big issue right now. So I'll leave it at that.
Well, I'll take the other side of the coin here. I mean, getting your arms around this and solving the problem is important, but perception is everything. And we've talked about this when we talked about civil unrest or homelessness or other things in big cities, or 28% of the people being in the offices or something like that. When people make their decisions about where to go, where to eat, where to vacation, right, where to send their kids to college, whatever it is, that perception that you see, and it may only be a 45-second news clip that you see in June, right? Sometimes that perception remains in people's head for 3 Junes, and it weighs on an economy for a long time. So they may clean up this problem in San Francisco very quickly, but that perception could linger. And that's what the collateral damage is that goes beyond the inventory and beyond the physical loss that you're seeing here. And we can hope not, right? Because I'm always rooting for these cities and I'm rooting for these retailers because they employ a lot of people. It's not, it's not the CEO of Westfield or Brookfield or anybody else that, you're thinking, wow, if their value of their equity goes down, they're still eating, filet mignon for breakfast, right? It's the people they employ. And that's, where my heart is.
I'll say this, and this is all I'll say, is that it doesn't help that a video of people breaking into a place gets 20 million views. A video of, hey, look, the streets are clean, everything looks good. Nobody wants to see that video, right? So there's this like self-fulfilling anger thing that the internet just naturally causes to occur, right?
Maybe
so
that
we'll
will be our New Year's resolution. We'll start a new endeavor where we try to push only happy videos, and we'll have a happy podcast separate from the commercial real estate.
We should just,
one.
We have our podcast on YouTube. We should just put like videos of like cats and kittens and stuff on there while we're talking.
Babies.
We could be
babies and kittens.
Who was the Al Franken character on Saturday Night Live? The really positive person that.
Yes.
Stuart
Affirmation. Stuart Smalley. Stuart Smalley.
We'll do a podcast like that.
We have a couple of trading alerts, loan modifications, and other news that we wanted to report on.
Sure. These were things that made it into our TreppWire, things that moved bond prices for particular deals. The first one talked about a Morgan Stanley deal from 2011. 2 big retail loans were modified. Westfield Belden Center in Canton, Ohio, got a 5-year maturity extension, pushing the maturity out to 2026. That loan had been in CMBS purgatory. It matured in July 2021. The Oxmoor Center, that's in Louisville, Kentucky, it was also extended. Its maturity was pushed out 2 years. Part of the maturity extension, the borrower had to reduce the principal balance by $4 million. Why does this one get my attention? For H1 2021, DSCR was only 0.89x. Property is 78% occupied. So between these two loans, they make up 94% of the remaining collateral behind this Morgan Stanley 2011 deal. That should be music to the ears of owners of the D and E bonds in those deals. We pointed this out in the TreppWire. Those bonds have coupons of 5%. If these loans had been foreclosed upon, sold off as note sales or anything else, right, that income goes away. Now you're expecting that income for those bonds to go out for another 5 years. So with these modifications, you probably have seen a huge run up in stock price, maybe in bond price, maybe 10 or 15 points as a result of these modifications. And it just goes to show, if you can get your arms around some of these and predict where these extensions are coming, you could make real money as an IO holder or as a premium bond holder, with the expectation that these loans in CMBS purgatory, retail purgatory, will be extended. If you're adventurous and you want to look at another deal, take a look at JPMCC 2012 CBX. There are 2 loans in that deal. One is the Jefferson Mall, one is the South Park Mall. Together, they make up 25% of the deal. The deal is in CMBX 6. This month, the special servicer workout code went from foreclosure to modification. That is not always the final word. Sometimes these things can change and it goes back to foreclosure. But if these loans do get extended, what you're seeing again is another spike in the value of those early pay AAA bonds that now, instead of paying off in 6 months, may linger out there for 2, 3, 4 years. So if you're adventurous, take a look at JPMCC 2012 CBX. And lastly, big loss coming on a CMBX loan. The Montgomery Mall in North Wales, PA, was sold out of foreclosure to the Cohan Retail Group. Joe can tell you a little bit about them. This story comes from the Philadelphia Business Journal. Natalie Castelny breaking another story once again. Property was sold for $55 million. The loan is $100 million. So we're going to see a $45-50 million loss on that particular asset. Back in 2020, we pointed out that the borrower was unwilling to inject additional funds into the loan. So not a huge surprise.
So man, I might have missed it, but just on the last one, on the potential big modifications, that's a deal in CMBX 6 as well, right? So
the JPM deal?
Yeah. That'll have some
CMBX
implications
6.
to the, if these loans were foreclosed upon and sold off with losses,
Yeah, a little bit more color on that. The special servicing notes had been talking about note sale for a long time, which is the fastest way to get rid of an asset. And if that happens, right, that's to the benefit of the CMBX short, especially if it's a short note sale, right, a DPO.
Right.
The fact that it's changed to modification, is more negative for the CMBX 6 short owner, because this thing could linger out there and they continue to pay premiums for a considerably longer period of time.
Right. I'm sure the shorts would then counter your argument and say, yeah, well, that's okay, as long as we can hold out, because usually the longer these things stay around, the longer they stay outstanding, the bigger the eventual loss actually is.
Right.
You mentioned Cohan as well. Cohan and Namdar are the 2 big names out there, right, that are buying up these malls. And I should give a shout out to our friend Yanni from B6 Real Estate Advisors. He put out a really nice kind of market report, and he was, I guess, gracious enough or silly enough to want to hear what I had to say about things. So we had a nice conversation. There's some excerpts in there about the area and industrial and other property and multifamily in the New York area. But you don't want to hear more from me, or you hear enough from me on the podcast. But the rest of the report is really nice if you're kind of in the New York tri-state area. check it out. I think he posted it on his website and on LinkedIn and other places. But anyway, when I was talking to him, he had mentioned that he had worked with both of these companies at one point or another. And, his impression was that, in general, they're doing a service, right? And they're reasonable buyers, and they're buying at what they think are reasonable prices and leasing up these properties. And they're not putting $10 or $100 million into the property to reskin it, but at the same time, they're keeping it moving and they're keeping it leased up and making a decent profit while they're doing it. So I think sometimes those companies get a slightly negative connotation in the press when maybe they're just part of the ecosystem. So Manus, I know this is the retail Bonanza episode, but I think we have a couple of other non-retail interesting stories, right?
Yeah, a couple of things that we touch upon. We don't talk about multifamily very much because there's not a lot of news. The velocity of transactions is extraordinarily high. Cap rates are low. We are seeing tremendous amounts of property sales at really tight cap rates. Every week we report on, I don't know, a half dozen new sales, often with record-breaking prices in terms of value per unit and so forth. One thing that caught my attention this week, the National Mortgage News put out what they thought would be the 12 hottest housing markets in 2022. That was a good read. The interesting thing for me, I guess it kind of underscored what we've said before, which is, for the most part, there are just markets on fire. And they're on fire because they're able to attract young millennial talent and big business. We've talked about them as attracting new office headquarters over time. So several of these are not big surprises for listeners of our podcast. Salt Lake City, always attracting new West Coast businesses. Boston, Mass, obviously a huge attractor of biotech companies. Atlanta, Georgia, we talked about Microsoft and Visa going there. Dallas, Fort Worth, you never seem to go a week without hearing them grabbing a new headquarters away from California or so forth. Same thing with Tampa, St. Pete, Austin, Texas, and Raleigh, Durham, another big biotech operator. I didn't name them all, but it is a good read where you kind of see where they expect multifamily to continue to surge in 2022. On the hotel side, I'll talk about a Smith Travel report. They said that occupancy is now only down in aggregate about 9% from 2 years ago, from 2019 levels, which certainly a green shoot nationally. Occupancy up to almost 63%. People will recall, we think that was down in the 35% range, 12 months ago or so. So I love hearing green shoots, and really happy to see that revenue per available room, RevPAR as they call it, down only 7.6% from 2 years ago. So for those embattled hotel owners, help has come, and there's more help hopefully coming on the way.
Another maybe green shoot. I think it's a positive, and I guess it'll depend on where this thing prices. But we actually just got an email from somebody from Varde asking for something about the podcast, which shout out to them. But it was also a story in Commercial Mortgage Alert last Friday about Varde Partners launching a CRE CLO backed entirely by hotel loans, $530 million deal. It's going to come to market after Thanksgiving, apparently. But I believe, I may be wrong, but I believe this is the first all hotel CRE CLO. We've had plenty of hotel, like SASB, single asset, single borrower deals, but I think this is the first CRE CLO. So, I guess to me, that's a green shoot, right? These guys are seeing enough demand or enough acceptance of this type of paper in the market that they're willing to launch this. Be very interesting to see the type of discount margins that these bonds get versus, some other property types. We have seen multifamily only CRE CLOs. So to see, the best versus one of the perceived worst asset classes, at least in COVID times, see what that spread is, will tell us a lot about the capital markets.
The last thing I'll touch upon, I'll touch upon one story from in the office segment. This comes from Bloomberg City Lab. it talks about how in San Francisco there has been a wave of property owners looking to challenge their tax assessments. I think we'll see more of this going on. The thing that really got my attention is the size of the assessed valuation reduction that the applicant is looking for. The source of the data is the San Francisco Assessment Appeals Board. The Westin San Francisco Hotel assessed at $1 billion. The applicant thinks 250 million is more in line. Dropbox, I guess this is their headquarters, the value 900 million. Currently, the applicant thinks 500 million is more in line. Wells Fargo, and I'm not sure which Wells Fargo this is. Wells Fargo has several offices. I was trying to figure this out. 750 million is the assessed value. The applicant wants a 41% reduction. So I think we'll see a lot of this. And I think that
there's one more, Manus.
Let's hear it.
So actually Donut Shorts sent me this. It was a different version of this story from Bloomberg. Oh no, it is the same. It's Romy, right? Romy Varghese and Noah Boyer, the developer of the Golden State Warriors arena, is also looking to reduce the assessed value by more than $1 billion. That's $1 billion with a B. So, I mean, we live in this space of valuation at Trepp, right? We deal with all sorts of players in the kind of appraisal and valuation and tax space. So it's kind of like an existential question, right? Like if you're Dropbox, right? Or if you own the building that Dropbox is a tenant in and Dropbox says, we're not coming back to the office, does the value of the building drop like 1-to-1 essentially with NOI? Or do we say, well, no, the potential NOI of this building is X and therefore that should be the value? So be interesting to see how these arguments pan out, between the tax consultants and the assessors in the next couple of years.
Yeah, and I think we'll see a lot more of this. And the bigger the problem in terms of work from home and sublet space, places like San Francisco, Chicago, maybe New York, I think the more you'll see of this, right? The more discounting you'll want and the more challenges you will see. I don't think you're going to see this level of challenge in Austin, Tampa, Fort Worth and other places.
Those are the places where you're hoping the assessor doesn't look at you.
Right, exactly. That's right.
Last year, if you remember last year, guys, do you remember that far back? Thanksgiving 2020, we were hunkered down with our immediate households. And for some of us, that's a small number of people. Well, this year we're not exactly home free, but there's a sense that we're in a better place than we were last year. So I'm going to give you guys a chance to say what you're thankful for, because I know we did this last year and not surprisingly, Joe went practical.
Wait, what did I say? I don't remember.
Well, you were about 3 weeks from having baby number 2. So you mentioned that bundle of joy that was imminent. And you also got practical because you had a smaller Thanksgiving gathering and you wouldn't have to fight people for the dark meat. So you were happy about that. And Manus, of course, went the tearjerker route where, he basically gave a shout out to everybody who had been working through the pandemic. And he listed some very specific workers at grocery stores, nurses, restaurant, childcare, elder care, food banks, employers that stayed open. I don't know if you guys have had a chance to listen. That was episode 48, but there's a little pause after that because it kind of got me in my throat a little bit. I was feeling a little verklempt at that. A little bit.
Well, I'll let you go first, Joe. What are you thankful for in 2021?
Well, I guess a microcosm of hybrid work life right now was yesterday. Yesterday was my wife's birthday and I was in the office and I gave her a nice gift in the morning and then I went to work and then, you know how it is when you're at work and you're also feeling like the pull, like I got to get home, but I got to work. And I'm lucky enough to be in a position in my life where, at work in the office, there's 10 or 15 people that I can talk to about cool stuff all the time, right? And they're coming to me, asking me questions. I'm coming to them, asking them questions. So getting out of the office is sometimes a struggle. People flagging you down while you're walking to the elevator and stuff like that. So anyway, I was able to kind of extricate myself from the office while kind of shouting answers back to people while jumping on the elevator. And when I got home, the whole family was over at the house. My son was sitting at the table, and, it was kind of like a classic view of what, life was like pre-COVID, right? You go to work, you come home, your kids are really happy to see you. Everyone's dad, right? That whole thing. And then, we have a nice dinner and birthday cake and everything else. And it was a very, very nice day. And it felt relatively normal. And I think, at least for me, my life right now is relatively normal. And I'm extremely grateful for all of the changes that have happened over the last year, including the ones that Martha mentioned, which is new daughter, new kid, new daughter, the most beautiful girl in America, Lucy, and new house and the whole thing. And, I'm just a very, very lucky person, right? I have to say. So extremely grateful that this is my life, So I'll leave it at that.
Martha?
Yeah, I'll be brief. Last year I got existential. This year I'm very practical. I am very happy and thankful for the medical miracles of vaccines and therapeutics. The COVID pill is just probably a few months from being commercialized. So I think the sooner all of that happens, the sooner we all will not even think about going back to normal. It'll just happen.
Well, I'll try to be brief because I know Martha's ready to yell off, a bottle of your best cognac and fresh horses for the men as she rides off to the chateau. But I'll run through a couple. I'm really grateful that there are more jobs available than there are people that need them, because the opposite would be infinitely worse. I'm glad that the economy is bouncing back and that people who want jobs can find them and make a decent or a better living, at whatever they do now than maybe they were making a couple of years ago. So I'm grateful for that. I'm really happy, as Joe is, that things have gotten back to normal. Love the fact that people will be seeing family again this Thanksgiving across the U.S. and some people will get on planes and there'll be bigger Thanksgiving seatings. And I hope Joe has to fight for the dark meat because that means that families are getting together again. And lastly, I'll repeat what I was, more or less what I was saying last year. Well, I'm thankful for everybody that keeps us going, right? Whatever that may be. We talked about crime and decay earlier in the episode, but that is such a vast minority of who we are as a country. 99% of the people put on the uniform every day and go to work as firemen or police or truck drivers or working at the ports and so forth, and that we all need to keep us fed and to keep us warm and everything else and to keep us safe. And that will be my closing line every year for as long as we do this podcast. That's what I'm grateful for.
And we should also just quickly say we're grateful for Haley, our producer, because without her, this podcast would be horrendous and we all would have been canceled by now. So thank you for that, Haley.
You read my mind. So with that, in fact, I was going to mention that, Haley, thank you to you. You keep us on the straight and narrow. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question, drop us a line, send an email to podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Enjoy your holidays, guys. Thank you for listening and stay well.
All right.